also do Martin. I am a professional trader. I trade for a living. I also do some education for the North American Derivative Exchange in Chicago, and I started off just trading, options and futures, and Nadex is sort of a combination of both. We'll be talking a little bit about that. Obviously, with any kind of financial presentation that's made, you need to have financial disclosures, etc. So trading, futures, options, swaps, any kind of financial instrument may not be suitable for every investor. You need to seek your own advice. You need to basically know what you're doing before you do it. We have our full disclaimer on our site over at apexinvesting.com. And of course, any trading decisions that you make are your responsibility. This is for informational purposes only. If you want to open a Nadex account, and we'll talk about Nadex, but you can open a free lifetime demo account and try all this out without having to risk a dime. You just go over to nadex.com. Okay, so that's one of the several links I'm going to be showing you today to help you get started on day trading options. And we're not really going to be, Nadex has two types of options, and we're not really going to be talking about the binaries today. Okay, so if you go over here, and you'll be able to see that they have tons of links. You have open an account, and you have trading platforms. Under trading platforms, you'll see demo trading platform. And then that will come up with a free demo account. They're open to people all over the planet. So with that being said, let's get into what we're going to be talking about. We're talking about Nadex spreads. What are they? Not Nadex binaries, but Nadex spreads. Okay, they're actually my preferred instrument. They're completely night and day, and they're more like a normal option in the sense of trading calls, vanilla calls, and vanilla puts. Than they are like trading, a binary contract. So you can go in there and you can trade the underlying market, or you can trade an option. But one of the things that happened when I first started trading was people told me, oh, you can't day trade options because the bid-offer spreads are too big or this or that or whatever. And they're really, regarding options, they're actually a lot better than CME most of the time. I've seen them have some really nice type bid-offer spreads for options, and they really are built for day traders because they literally expire in a day or less. So I'm going to talk about why I trade Nadex spreads, what's the value. If you like trading futures and Forex, we'll talk a little bit about how to reduce your risk trading futures and Forex using these options. And one of the great things is you can trade in any market condition if you have options. You can trade in flat markets, volatile markets, choppy markets. There's a lot of different ways you can trade with them. And they're open from 6 p.m. Eastern time to as late as 5 o'clock Eastern time, depending upon what contract you're trading. So they're open for 23 hours a day. It's whatever your schedule is, you can actually trade these contracts. A few things I've learned that are needed in order to have a possibility of making money in trading that you have to know is, one, you have to know how to reduce your risk, because the first rule in trading is survival, right? So you need to figure out a way to reduce your risk. At the same time, you need to increase your leverage, which is often seen as an opposite thing of reducing risk. So you want to increase your leverage because that means you want your dollars to go further. $1 has $10 or $1,000 in buying power, So that's increasing your leverage. But often that has a dual-edged sword unless you're using something with a defined risk product like a Nadex spread. And you need more time to be right. Those who trade just outright futures, outright Forex, you've probably often seen that, you go into trade and, you were right, but you weren't, right at the right time. So basically it went against you, it hit your stop, and then it went back in your direction, right? So options help you get that more time. They also help you get that leverage, and they, help you reduce that risk. So they accomplish all three. Now, Nadex calls them bull spreads, but if you buy them, they're bullish. If you sell them, they're bearish. So I call them a box spread because they look like a box if you draw them on the chart. And just to compare, and you're like, okay, I don't know about this. Let's look at your leverage and your risk, comparing this to a Eurodollar ETF, a spot Eurodollar position, looking at a Eurodollar future, and looking at a Eurodollar future option versus a Eurodollar Nadex spread. Okay, so to equalize them all out, we went in and I basically equalized out the sides. I had to do 12.5 spreads, and they can't do half a spread, just to make it as equal as possible. And what the price was. So price of 125 on the ETF, 1.2500 on spot, USD on, futures, And the options would be priced at a penny because you buy 125,000 of them. And the year Nadex spread 1.25, 10. So a little bit higher there with the optionality. The value across the board equal 125,000 as far as leveraged value. The margin that you had to put up to place the trade on the euro dollar ETF, 31,250. On spot euro dollar, you had to put $3,125. That's if you're like on a 50 to 1 leverage. Okay. Over on euro dollar 6E, 250 to 1 leverage, and that's at putting up $500. And if you're doing the future options, you'd have to put $2,500, over $2,500, and almost a 50 to 1 leverage. Using the euro dollar Nadex spread, exact same contract, $250. So less money than all of these, 500 to 1 leverage. So you're getting 500 to 1, but your margin is only 250. Now, one thing to remember is your maximum risk is your margin on an option, on these types of options. No matter what direction, no matter how you use them, your max risk and your margin are the same on Nadex spreads. Whether you're long the spread, short the spread, doesn't matter because they have a cap. So my risk is 250, no, maximum, worst case scenario, no matter what. And so I'm getting massive leverage with defined risk. Many of these contracts, besides the options right here for the futures, don't even have a capped risk. That's just the margin, the $500 you got to put up plus profit and loss. Spot euro dollar, 31.25 plus profit and loss. That's for 125,000 units of currency. 31 grand at a 4 to 1 leverage on the euro dollar ETF. So I went out here and I said, okay, well, what if the market moved up from 125 to 127.40 or down to 122.50? What would I make? What would I lose? Well, looking at the ETF, I'd make $3,000. I'd lose 31.25. Looking at the spot euro dollar, I'd make 3,000. I'd lose 31.25. Looking at the futures, I'd make 3,000. I'd lose 31.25. Looking at the future options, because with optionality, 1 month till expiration, you're going to have gamma that moves slower, and you're going to have theta that's built in there, and all that fun stuff. You're going to make $463 on the same move, but you put up quite a bit more money. And if it moves down, like today type thing, then you'd lose $12.50 just with the delta of a 1 month expiration option on that. The euro dollar Nadex spreads, if it moved all the way up there, you'd make pretty close to the same amount of profit, $28.75. We're talking like $25 off here. If it moved way down, you'd only lose $2.50 because remember, you had less risk, more leverage, and defined risk. So we're looking at literally doing the same trade against a ETF, spot FX, euro dollar futures, future options, and euro dollar Nadex spreads. And I want you to see this: more leverage, 500 to 1, defined risk, $250. So that's on the exact same move, putting everything on the same level. So if you understand that, and you may have to watch this slide again from whenever the recording comes out, but the bottom line is you're getting better use of your money, and you have more defined risk at the same time. And you might start to grasp why I love this product personally as a trader. I have all these ways I can trade the euro dollar, for example, and that shows me the benefits of that. So on the Nadex exchange, all their products are capped risk, meaning the money you put up, it can't get worse than that. You cannot get a margin call. Okay, you can never lose more than your margin, your risk that you put up. You obviously, as you can see, still get massive leverage. You can trade stock indices, you can trade future commodities, and you can trade Forex pairs. What moves the price? Is it supply demand? No, it's an option. An option's price primarily is driven by the underlying market and other factors such as time, volatility, things like that. So it's not driven by people go, what's the volume of the spreads? And they have market makers that guarantee liquidity to make sure that there is a okay. So you don't really I've never had to worry about it, and I trade some pretty big sizes. So as long as the market's moving, then it's going to mirror the market based on how an option works. But it's really nice because it's really simple because it's only 1 day until expiration. So maybe 1 hour till expiration. They move in pips or ticks, okay, which is the last digit of the quote. So if it quotes at 1.25001, then the 1 is the pip or tick. And every digit or pip or tick is worth $1, which is really nice. You don't have to deal with converting yen to dollars or francs to dollars or, yen back to pound, back to dollar. You don't have to worry about Does it tick in quarters? Does it tick in dimes? Does it tick in, this percent of a bushel or, whatever? It's all $1 a pip or tick. And just to show you a simple example, and obviously, some of the prices on here are outdated, but the concept still works the exact same, is let's just say we're looking at euro dollar or whatever instrument. I don't care if this is ES or TF or gold or, whatever it is that you like to trade, okay? 2400 to 2500. So 1.2400, 1.2500 doesn't really matter. What matters is that how that tick works. Now, the reason they're called a spread, people are like, why is it called a spread? Well, a spread is the difference between the floor and the ceiling. So 2500 minus 2400 is 0.0100, right? Remember I said the last pip or tick or digit is the actual tick. So right there, that number right there is the number it ticks in, and it's always going to tick in an increment of 1. So like the Dow has no decimal, right? So the last digit would be the 1, whereas there's 4 decimal places here on euro dollar, so the last digit is still going to be 1. It doesn't matter what it is, even if it's natural gas or S&P E-minis or whatever, it's always going to tick in a 1 or a 0.1 or a 0.01. And all you have to do is look at the quote, and that last number right there is going to be the pip. So if every pip is worth, or every tick is worth $1, there's 100 pips of value in this spread, maximum potential value. Okay? So 100 pips, every dollar a pip, spread's worth $100. So what does that mean? Well, remember I said there's defined risk, there's also defined reward, okay? And I show you how to even open up the reward where there's no cap on reward in some of the other trainings that we do for free over at Apex Investing. But just to make sure you get the basic concept down, if I'm, let's say, going short, I think oil's going down or euro dollar's going down or whatever. If I'm selling the spread, I can't lose any additional money above the ceiling. I can't get stopped out. And this is one of the things I love. You can be down, but not out on the trade. Okay? And then I can't make any additional below the floor. And some people go, man, you can't make money below the floor. I mean, they have 250 pip wide spreads. Okay, these are 100 pip wide right here. For this example, how many of you are grabbing 100 pips a trade? Maybe 100 in a day, but 100 a trade. Okay? And if there you are, there's 5 spreads. There's plenty of spreads for you to go, okay, I'll just close this one and go to the next one. That's a good problem when you run out of profit room. You just go to the next contract. But in reality, most of us are grabbing 20, 30, 40, 50 pips, hopefully, on a trade. And to help define the math on here about that can't lose more, if the ceiling is 2,500 and I sell at 24.90, the difference between those two is 10 pips. Okay, 2,500 minus 24.90 is 10 pips. That means my maximum risk, if the value is $1 a pip, $10. Right? 10 pips, $10. And that's also my margin. Where can you go and trade euro dollar and put up $10 and control a mini lot? Because a mini lot is $1 a pip, right? So you have a mini lot of value, 10,000 units of currency, where you're putting up $10 to control that. So even greater than 500 to 1 in this example. And this happens all the time. It isn't a rare thing. So every pip is worth $1. There are 10 pips. Max cost is $10. So if it goes up 30 pips against it, we're still only down at a maximum $10, and it can still come back in our favor before it expires. All right. Now, how much can I make? Well, I could make, if I sold it at 10 pips below the ceiling and there's 90 pips down to the floor, 24.90 down to 2,400, the difference where I sold and the floor, 24.90 minus 2,400 is 90 pips. There's 90 pips of profit potential. Every pip's worth $1, 90 pips profit potential. The profit potential is $90. Now, I can close it anywhere I want to. I can close it 10 pips later, okay? If I sold it at 24.90, bought it back at 24.80, I'd make 10 pips. If I sold it at 24.90 and bought it back at 24.95, I'd lose 5 pips, okay? And it doesn't have to, if it closes below the floor, I make the maximum. If it's, if it literally like expires there below the floor, I'll make the maximum of 90 pips. It doesn't have to expire like in between the center or anything like that. And it's cash settled instantly. Like when it cash settles, let's say this settles at 3 o'clock. Then at 3 o'clock, within seconds, I'll have all my margin put back. So the $10 plus, let's say if it settled all the way down, plus the $90. So they'll put a $100 credit back. $10 of risk that I put up, that was my max risk, plus the $90 in profit I made. Or if it settles, in the middle, they'll put back, say, $40 of profit. plus the $10 I made. Okay? Now what if I'm buying the spread? I can't make additional above the ceiling. I could always buy another spread because there's higher spreads. I can't lose additional money below the floor. So again, I can't get stopped out. So if I bought at 24.10, my risk would be the difference between where I bought 24.10 and 2400, the floor. So 10 pips. Again, it doesn't matter if this is oil or gold or natural gas or FTSE or DAX or Nikkei or China 50. Rules work the exact same way. So the difference between these two, 10 pips, $10. Okay? That's my risk. That's my margin. $10 to control a mini lot. Going long on $1. And let's say I hop in and it goes boom right against me and then flies on back up. I'm still in the trade. Even though I was only down 10 pips, even though maybe it went down 20, 30, 40, 50 pips, I'm only down 10. Okay? And my profit potential is where I bought, and a maximum potential all the way up to the ceiling. Again, if it expires way above the ceiling, I'll make the max. It doesn't have to expire in between the floor and ceiling. But if it expires lower than the ceiling, then my profit will be the difference where I bought and I sold, like everything else you're used to. So if it expires between the floor and the ceiling, your profit will be the difference between where you bought and sold, like on everything else you do in life. If where you buy something and sell something, that difference is your profit. The only difference here is your max loss. There's a maximum loss without getting stopped out, and there's a maximum profit potential on that specific spread. Okay? Now, again, you can close it at any time. So you could go short, you could go down, you could buy it, it could fly up, and it could go way down here against you, and it could fly up, and you could close it out and go short again. It could come down, and you didn't ever close it, but it came back up, and you closed it. You could buy it, it goes back up. You can close it any time you want to before it expires. And like I said, the contracts anywhere between 23 hours or less till expiration. And it tells you right on the Nadex site and on our scanner that makes it really easy to trade these. I have a whole course on detail on how to trade the spreads. All of the courses at apexinvesting.com are free. All of our education is free. So if the spread expires at settlement, cash settlement basically looks at where is the market at that time. Okay, they take a simple formula like the last 10 quotes and subtract the top 4 and bottom 4 and divide the middle 6 mid prices and then that settlement, just like CME does, and any options exchange has a settlement formula. But it's done quickly. You're not waiting until tomorrow. Literally, your money's freed up, and you can go and do another trade. Okay? There's a large combination of markets. This is really a quick intro to Nadex spreads for you. There's a large combination of markets, time frames, and spreads. And what does that mean to you? It means that you can find a lot of different choices to place a trade. I can watch a variety of charts. They all work the same way as far as math. I don't have to worry about quarters and dimes and nickels and tick values. Everything's a dollar tick. So I can, find ones that, have risk and reward parameters and the option setup that, it fits my strategy. They have intraday contracts that last as little as 2 hours. I mean, you could get in 15 minutes before expiration, up to 2 hours. They have ones with 5 hours and 8 hour time frames. They have ones with 22 hours and 15 minutes. Actually, the longest one because it goes from 6 to 4:15. And the expiration and settlement, they have the days of expiration, time of expiration. Everything's quoted in Eastern time, so that's really helpful to know. I personally like to have, since all my financial news and media and stuff is coming in Eastern time, I usually set my trading computer to Eastern time, so my charts are at Eastern time, and it makes everything line up. It makes it where I don't make a mistake and think, oh, I have an hour. I really don't. So just a small tip. If you change your clock and then open your platform, most platforms will update to at your computer clock. The range with distance, this is a floor and ceiling, and they have ones that are 100 pips wide, 250 pips wide. They have 1,000 pip wide spreads. And they'll have, 3 to 5 contracts on every spread. So that way you'll be able to go in and you'll have one like where the market is, you'll have one above the market, one below the market. There's a lot of different ways to use them, and I teach you that over on the site. Can't do all that in 30 minutes, but this is just to say, hey, this is a product you might be interested in trading. I enjoy trading it. I have thousands of other traders that I know that enjoy trading it. And, is this something you might want to check out? When I first found out about it, I drilled Nadex for about 4 hours, just trying to figure out every, hole in it. And at the end, I loved it and been trading it ever since. Let's see here. For an example of multiple contracts, this has like a big, what we call daily master spread right here. And in this case, that's 600 pips. And this is on euro dollar. And then it has one that lasts, 5 hours. That's 250 pips. See, 250 pips from where the market is up. That's the floor and the ceiling. 250 pips from where the market is down. And then one that's straddling the market there. So 125 up, 125 down is the floor and ceiling. And there's also a 2-hour contract going at the exact same time. So you go in here and there's one and it's only 100 pips because less timed expiration, it'll be a little smaller spread. So 100 pips up from the floor, 100 pips down from the ceiling, and then 100 pips straddle in there, 50 pips up, 50 pips down. And that's just an example to show you if you drew out the box spreads on a chart, this is what they would look like. Okay? Looking over at instruments, what markets are they on? They have them on euro dollar, pound dollar, dollar yen, euro yen, pound yen, dollar CAD, and dollar franc, and they've actually added Aussie yen now as well, and euro pound. So now we have Aussie yen and euro pound. Need to put that on there. I've been trading a lot of those. But they've added those two FX pairs as well to them. And they mirror the spot Forex. Okay? The commodities, and people go, what is a commodity? A commodity is something you can drop on your foot and it hurts. Like, a bushel of corn or, 100-gallon barrel of oil, or, a whole bunch of gold, right? So it's a commodity. It's physical. If you drop it on your foot, it hurts. So they have corn, soybeans, oil, natural gas, gold, copper, and silver. And over on the U.S. indices, they have the S&P, the NASDAQ, the Russell, and the Dow. Now, they follow the futures. They don't follow it. The S&P follows ES. It doesn't follow SPDR ETFs or SPX index, which are similar but not the same, okay? They follow the futures data. And we show you how to get access to that data as well without additional charges there. We'll show you how to get all that set up. But they follow the S&P futures, the NASDAQ futures, the Russell 2000 futures, and the Dow Jones 30 futures. On the international indices, they have the FTSE 250, the FDAX, and the SGX. Hey there, I think your mic came unmuted. All right, and we have the international indices, FTSE 250 again, FDAX, SGX, Nikkei 225, and we also have the China 50 is now added on as well that you can trade. So they're constantly expanding and adding on new markets. And one of the things I want to show you is what I call the Whipsaw elimination strategy. And let me see here if I can pull something up for you. On the Whipsaw elimination strategy, it's basically just the simple use of a spread to help you avoid getting whipped out of a trade. Okay? So I want to help you compare bull spreads to underlying markets. All right? Everybody has seen this chart before. Okay? It doesn't matter what symbol's in the top left corner. You're looking at it, you see a trend line, a chart that you've all seen before. Okay? And it's drawing a trend line. Going, hey, got a trend line here. I think, hey, it'll bounce off, it'll come down. I think it'll actually retrace down and end up maybe forming a flag or whatever you want to call it, right down to this 1.56 level. And so looking at the chart, you're like, okay, it comes over here. I'm going to go ahead and go short and move it on down. But I want to be a good trader. I want to manage my stop. So I'm going to put my stop up here, and I'm sick of getting stopped out. So I'm going to put it way up here above this recent high, so that way I don't get hit. Right? That's worked real well for everybody. Right? And after we do that, then we're going to go ahead and put our stop loss. Say we're going to go short 56.85. We have a stop at 57.50. That's a pretty decent sized stop. But it's a really volatile market, so we want to make sure we give ourselves plenty of room. The risk on this trade, doing a one lot, 100,000 units of currency, would be $650, plus the margin requirement of $3,138. So we know that we could actually have to have a $4,100 drawdown, a little bit over that. But $650 would be our risk if it went up there and got stopped out. And when you know it, it goes up and you get stopped out. And the hardest part about this, you tell me, but in my experience, the hardest part about this is it's not even getting stopped out part, it's as it's edging up, right, towards your stop. And in your mind, what are you doing? You're like, should I get out? Should I move my stop? If I do get stopped out, do I go long? Because now it's flying up, or do I go short, or do I just sit on my hands and watch it go back in my favor and miss out on all that money Now I lost and I lost out and I didn't do anything, or what do I, it messes with your mind and you mess with your stops, and that happens constantly, and it makes it very hard as a trader. And then just to really make sure it just, sticks it to you, it goes right back in your favor right after it hits your stop and then hits your take profit. Right down there at 1.56. So you're like, oh my gosh, like I knew I should have moved my stop. And then the next time you move your stop, and what happens? Well, then it goes up further and it hits that stop. Or you go short and then it goes long, or just on down the list. So it's like no matter what you do, it just seems to mess with you. And so with these spreads, you can do this exact same trade with this exact same analysis. Again, it doesn't matter what the instrument is. Exact same trade, exact same analysis. But you don't have to have that happen to you like literally ever again if you want to use the capped, selling benefit of trading an Nadex spread. So you want to go short. It takes 250 pips. It has plenty of room for prop potential. And you have to pay a little bit of optionality, like say like 10 pips of optionality on there. But you sell over at 56.65. Your ceiling's at 5,700. So you have 35 pips at risk. You're doing 10 contracts. So 10 times 35, every one of them being worth $1. You're risking 350. Remember, before we were risking 650. You only have to put up your risk, which is 350 margin versus a $3,000 margin. Market goes up, you're not happy, you're down, but you're not out of the trade. You may be down to 350 right now, but there's no value left in the option. But you're not out of the trade, and your risk isn't increasing. You accepted that risk when you entered the trade, and now it's just you're letting it play out. And then it goes back in your favor, and you're actually able to make a profit. So $760 expires at 15589. So let's look at the comparison of the two. We got the underlying spot risking 650, the spread risking 350. The spot FX, again, same trade, same analysis that you use right now, $3,000 margin, margin 350. Loss on the spot, 650. Profit on the spread, 760. I mean, that's pretty cut and dry. So something that you definitely may want to go, you know what, this is probably worth looking a little deeper into. You can also use them for multiple strategies. You can go directional. You can go non-directional, like you can do straddles. And, hey, I think the market's going to go really far one direction because of a news report or something. You can do premium collection. I think the market's going to be flat. You can actually collect premium. You can hedge. You can actually go in and say you were going long on that euro dollar or pound dollar. You could sell a spread and have it to hedge a position off. So that really is the summary of my presentation. Again, I'm going to invite you to go to nadex.com and get your free demo account. And I also invite you to come on over to our website. Again, it's free, apexinvesting.com. And if you'll do that, if you'll hop on over to apexinvesting.com, you can get free access. And then when you log in to the website, we have Elite Education. And you can go under here, and here's a whole section on Nadex spreads. We'll get you completely up to date. And we even have scanners and other free tools that you can use that make it a lot easier to trade the spreads, that do all the math for you. It's a lot easier than using the platform that they have. We sort of made our own skin for the platform, and we give it away free. And so there's tutorials on that and free access to that as well. And I look forward to seeing you over there. We have a forum where you can ask all the questions that you want. And I'll be happy to help you out in any way I can.